Yeah, hi Ankit.
Hi Vivek.
Okay.
Okay, so we are live now. Hi everyone. My name is Ankit Kejriwal. I am senior analyst at ST Advisors. Uh, we're just going to be waiting for a couple more minutes till everybody join, and then we will begin with the Ask Me Anything webinar. In the meantime, Vivek, if you could share the screen.
Yeah.
All right, I think we can start now. So welcome everybody to ST's September Ask Me Anything webinar. My name is Ankit and I welcome you all to this webinar. We have with us Vivek Sharma, who is the VP and Investment Head at ST Advisor. He's going to be taking you through the rebalance related update for Gulaq portfolios. So the agenda for this webinar is first, I'm going to be sharing a little bit about ST and Gulaq if you don't know us already. Then I'll hand over the stage to Vivek, who is going to be taking you through the rebalance related updates, in which we will discuss all the updates that we did this in the September month rebalance. So we do rebalance every single month for our portfolio. And Vivek would be sharing what are the updates that we did this month, and also we'll be breaking down the performance of the portfolio in the last month, which was August. So, Vivek, if you could go to the next slide. So, a little bit about ST. ST was founded in 2008, which was around the time when SEBI allowed algorithmic trading in India. So, ST's roots are deeply rooted towards a quantitative and systematic investment philosophy. So we have extensive over a decade of experience in building sophisticated quantitative products, mainly for institutional and high net worth individuals. And we have been recognized by multiple exchanges, including NSE. We have received an institutional member of the award in 2019. We operate in across 6 countries, and we have AUM of over 1,500 crores across all the different products. Gulaq is basically a retail investment advisory arm of ST. So ST's founding team, which includes Vivek, had the idea that our institutional investment methodology, our investment product should not be limited just to institutional investors, to high net worth individuals. It should be accessible to everybody. So we created Gulaq with the aim of using the same research that we were doing for our institutional and high net worth clients at ST, but package it in a more retail friendly manner so that we can create a smaller portfolio with lesser number of stocks with a smaller investment size and offer it to retail investors at a very affordable price. So we launched Gulaq in 2020. So we have over 5 years of live performance track record, which has been pretty amazing, and you're going to see that very soon. Uh, we have been on the platform which is called Small Case. We are majorly present on that platform, and we have been recognized by uh, the platform as one of the best managers on the platform. We have consistently ranked the best in terms of most number of subscribers and most invested small case. To this date, we have served over 27,000 clients, a number which we are very proud of. And our strategy is purely quantitative. It's a multi-factor based methodology. Vivek, if you could go to the next slide. So our team includes Mr. Sandeep Tyagi, who is the founder and CEO of ST Advisor. He has done his BTech from IIT Delhi and also holds an MBA from Columbia Business School. He has over 30 years of experience in portfolio management, analytics, and consulting. Uh, the founding team also includes Vivek Sharma, who is going to be taking you through the slides very shortly. He is the investment head at Gulaq. He has done his BTech and MTech from IIT Kharagpur, and he holds 20 plus experience in trading and investment management. A quick disclaimer: ST Advisors is a SEBI registered as research analyst. You can see our research numbers on the screen, and disclosure. Investments in security markets are subject to market risk. So you should always read the documents carefully before investing. And you can see the other details, which is a SIN number and our registered address on the screen. Vivek, if you could go to the next slide. Okay. So before I hand over the stage to Vivek, a quick announcement. We have launched a Gulaq WhatsApp channel. So a lot of you complain that we forget rebalancing the portfolio every single month. So we have heard you and we have launched a WhatsApp channel so that you never miss the rebalance updates. So every single month we will be pushing an intimation on this WhatsApp channel so that if you are an investor, you can get timely updates from us. So if you are an investor, you should definitely join this channel. And even if you're not an investor, you should join it because we always release a lot of educational material to everybody, which includes timeless investing principles. We share Vivek especially shares a lot of blogs and educational material on this platform on the platforms to educate the investors. So I'll be sharing the link soon in the chat and you can join this channel if you haven't already. Over to you, Vivek, now.
So let's move on to the rebalance update. But before that, there are a lot of new investors who have joined us over the past couple of months. So for them, I just wanted to take them through our gear-based methodology. So a gear-based methodology, although gear 6 is the most popular one because returns wise it has produced the highest returns, but also at times like these last 1 year where equities hasn't given any meaningful return, people are now realizing the importance of asset allocation, and that's what these gears are based on. So gear 6 is 100% equity, gear 5 is 80% equity and 20% debt. Gear 4 is 60% equity, 40% debt, and Gear 3 is 40% equity and 60% debt. Right. So the more debt you have in your portfolio, the conservative or the less risky, the less volatile it's going to be. Obviously, it comes at a cost of lower returns. But at the end of the day, if you are unable to really hold on to your portfolios with 100% equity, it's not worthwhile. So dependent on your risk profile, you should be selecting one of these. There's no point subscribing to two of these because the equity component is same. Yeah. Okay. So rebalance update related to the large, mid, and small cap allocations in the Gear 6 portfolio, and we here mostly talk about Gear 6 because as I told you, the equity component is exactly the same everywhere. It's just that the allocation to equity is different. But those specific stocks are going to be the same in all the gear-based portfolios. So we see from August to September, our large and mid-cap allocations have gone down, whereas there is a significant ramp up in the small cap allocation from 18% to 36%. These are the changes related to the sectors. So overall, if you see, there are two things that one should compare. One is the BSE 500 allocation to these sectors versus what our sector it is, and secondly, the trend. So if you see the healthcare, we were already quite bullish, and from August to September, again, we have increased significantly. Again, financials, we were actually not that bullish. We were underrepresented. So BSE 500 has 30% uh, of financial companies, whereas we had 22%. Now we are close, slightly above that 30%, right? And you can see the bottom industrial, energy, consumer discretionary, IT. These are the sectors where we have reduced our weightage from the last month. Significant here are these two actually, consumer discretionary and IT, where we had some small allocation. These two combined has 20% allocation to in BSE 500, whereas we now have 0% allocation to this. Now these are factor-wise weightages. So if you see in September, we have allocated weights to momentum, quality, and value. And the change has been that now we have gotten some allocation to momentum. Earlier, momentum was not working. And since April, we have had zero allocation to momentum. But September is the first month since April where we have had some allocation to momentum. Quality allocation has also gone up, whereas value allocation has actually come down drastically. So these are the three factors using which we are now constructing our portfolios. Performance also last 1 year has been tough for us. It was first tough year for us since we launched in May 2020. Since then, we have delivered about 43% annualized returns. And last 1 year, as you can see, was in negative. But now, looking at the short-term performance, it looks like that we have turned around the corner and the performance has actually started coming back. So if you look at last 6 months, it's also is slightly positive. Similar is the trend for Gear 5 also. And for Gear 4, because it has much more debt, our 1 year performance was also close to zero. There seems to be some issue here because 1 year, all three are showing zero. I'm not sure.
It's not an issue, Vivek. It's 0%.
It is 0%.
Yes.
Both, yeah.
Yeah.
Oh, interesting. So it is exactly zero for us and benchmark as well. And this is Gear 3 performance because we have much more allocation to debt. In 1 year, also, this has produced positive returns. So that's the advantage of having debt overall in our portfolios, that over long run, the returns are more stable and you are able to hold on to your portfolios. This is the overall summary of Gear 3 to Gear 6. And since beginning, as I touched upon, we produced a CAGR of 43%. This is obviously gross. After this, there is going to be some uh, transaction costs and taxes, and obviously the fees is there. But the point here being the CAGR of index Nifty Multicap 500 is 22%. So we have produced significant alpha that even in spite of paying those costs, we're still far, far ahead of the index over last 5 year duration. And if you see last 5 years, our rank across small case portfolios, there are, I think, about maybe 500 odd portfolios on the small case platform. So we are ranked third in that specific category. So if you look at this 5 year CAGR from high to low, we are ranked third, and our 5 year CAGR has been 39%. It's quite impressive what we have been able to achieve and what we have been able to deliver to our long-term investors client. We also launched our large, mid, and small cap portfolios around the end of last year. Again, in this, the performance has been slightly negative in all three, actually. But the short-term performance, obviously, we are seeing some turnaround and some positive alpha in short term. Small cap obviously has been positive since inception, right? And for your reference, we have also given the back-tested returns at the bottom. So take it with a pinch of salt, but it gives you some indication of what we are expecting. Obviously, the 10-year CAGR or the excess returns of almost 20% in small cap, uh, it's very very hard to replicate, and backtesting is slightly you must discount backtesting a bit, right? But it gives you some indication of what could be expected. Obviously, we won't expect 20%, but even if we are able to produce, say, about 10% alpha, if we are able to do that over long run, that is very impressive performance. If anyone is able to do that. Okay, now let's move on to the questions that we received, and I'll encourage all of you, if you have any questions for us, please put it down there in the comments and we'll be happy to take all the questions. First, I'll just take the questions that we received in the forms. So Tushar has asked, I wanted to understand the major goals of Gulaq in the near future. First question is, what sectors are you going to focus on in the near future? So Tushar, our methodology is such that we are not focusing on any specific sector as such, right? It totally depends on the market conditions. It is really not about prediction. So when we focus on the future, we are actually trying to predict what is going to happen, right? Whereas the algorithm, the way it is designed, it always adapts to what is happening in the market. So let's say tomorrow, if healthcare companies keep doing well, we will be increasing our exposure to healthcare companies. Whereas if they really don't perform as well as we are expecting them to perform, the algorithm will keep reducing. So it's never about prediction. We are never able to predict even one day in advance what is going to happen in the next rebalance. It's always about adaptation, that based on the new data that has come in, based on the results that have come in, based on the prices and all the news, we adapt and or rebalance our portfolios. What growth projections do you expect for portfolio in the coming years? Just an overarching idea. So, Tushar, I'll tell you, I'm also invested in this strategy. My expectation is that if I get, let's say, 6 to 9% alpha over next 5 years from this, I'll be a happy investor from this over the benchmark. So that's what my expectation is. Although I have received much higher returns in the past, but I'm really won't expect that in the longer run. So I'll be happy if I'm able to get after costs, if I'm able to get 6 to 9% alpha. It's a healthy rate of return. It's a very good, impressive rate of return, in fact. So that's what I will expect. Lastly, what strategies differentiate good luck from other small cases? So uh, I believe, Tushar, our focus on research, our in-depth understanding of quant-based strategies, because we are an early mover. We have been trading systematically since 2008, and doing this research, focusing on this research, we have a pretty decent sized team, well qualified team who actually are always looking to improve these algorithms. So our focus on research is primarily our differentiator, and it is there in the results. As I've just shared, last 5 year rank, our rank is third. So our focus on research, I think, is the exact differentiator amongst other small cases. Yeah. So Sumit is asking, do stocks in the portfolio get affected by tariffs or GST? So Sumit, as I just explained, these are things which can never be predicted, and we don't waste our time predicting what could happen in the GST. Now that we have received this specific information, we are going to ingest all of the information that would come in over the next couple of days and weeks, and in the next rebalance we are going to take into account, this will be taken into account in all the data that we use in constructing our portfolios. So these are initial reactions that we have seen today, but over next couple of days and next couple of weeks, uh, a lot more information is going to come up, a lot more analysis, and the way stocks react, the way sectors react, that is going to be input to our algorithms. So this will be taken into account, but these kind of whatever news or events do impact the markets, we do take into account only on a monthly basis, which is a fairly decent frequency on a monthly basis if we are do taking into account. Every buy and sell incurs brokerage charges. So if 50% of the portfolio charge changes every month, we lose around 1%. Unfortunately, this cost is not considered by small case. Please advise. Manoj is asking. So Manoj, you have a fair point, but I think this cost is a bit exaggerated. What we are seeing in our PMS. So PMS similar construction methodology, although because PMS runs with a 50 lakh portfolio, it's more diversified, but churning is almost similar. So in that, what happens is we get maybe about 2.5% annualized cost, which is brokerage plus slippage, right? Because we are using state of the art execution algorithms. Now, on small case, obviously, retail investors don't have access to those kind of execution, so the cost will be higher. My assumption is the cost could be anywhere between 3 to 4% overall, but it depends. For some of the full service broker, if you are using full service broker services and paying huge brokerages, in that case, cost could also be 5 to 6% annualized, right? I really doubt this fact that Manoj, you have written that 1% is the cost, which means 12% annualized. Really, either maybe check your brokerage, how much you are paying, or maybe you can get in touch with us, our support, to get an idea exactly about your portfolio. But 1% is really hard for me to understand. Why would you be incurring 1% overall? It could be 3 to 5% in that range on an annualized basis, but this is about 12% analyzed. So I don't think really. So you can maybe send your statements, talk to our support staff to see what's going on in your portfolio, right? But yeah, these costs, if you look at the small case performance, these costs are not considered, and the primary reason is that everyone is on different brokerage plan. And these costs are a big factor is that brokerage that you're paying to your broker. I am a subscriber, an investor in Gulaq Gear 6 for last 3 years. Currently, my XRR is 26% as per small case app, without considering any charges or brokerage. After including subscription and brokerage charges, my XIRR comes down to 15%, and I further include 20% STCG. It drops to about 11%. In comparison, any average flexi cap has delivered 17% annualized, which is mostly subject to LTCG. So I want to know your perspective on this. What makes Gulaq different from mutual funds when we consider the end results? So Bhargav, I'll answer the second question and then we can look at the returns also. Um, so last 1 year we haven't performed well. Uh, so maybe there are few multi caps or flexi cap who have done better. Last 3 years, even we have done about 17%. If you take into account some slippages, it's going to go down to about maybe 14, 15%. Last 5 years, longer term, if you consider, I think we have delivered significant alpha over any average flexi cap or multi cap fund. So even after paying those uh, costs and taxes, you are going to come out ahead. So it totally depends on the time frame you're looking at, but uh, the larger the time frame, the more weightage you should give. So over since inception at least, we have delivered significant alpha over flexi cap and multi cap funds. That is one point. Secondly, when you have mentioned here your XIRR is 26%, but after subscription brokerage charges, your XIRR is coming to be 15%, which is quite significant difference. Now, here again, Bhargav, what I would like to point out here is this is quite significant. Most of our investors don't really face this kind of gap or leakage in their portfolio. So one thing is please do check, or if you can mention right now which brokers you are using. If you are on full service broker, this difference would come down if you move to actually a discount broker. That is one thing. And secondly, also your return subscription costs. If the portfolio is smaller, say about 1 lakh, quite a few investors have 50,000 to 1 lakh. So in that case, you're paying quite significant. On 1 lakh, you're paying almost 6% to us as the fees, advisory fees, which is not reasonable, which is very high. So what we advise is that have at least 3 lakh in your portfolio. In that case, your overall fees is going to be 2%. So the higher it is, the better, but around 3 lakhs is definitely one should have to make sense of the fees. And secondly, my point being that you should definitely check how much brokerage you are paying. Looks to me that you're paying much higher brokerage than what is available in the market. Now, Gaurav is asking how much of your portfolio rebalancing and stock discovery is driven by AI. What are your views on oil India? Where are we still? Why are we still bullish on it? So, Gaurav, it's very hard for us, and we don't really comment on stock specific views because at the end of the day, this is driven by the algorithms that we have designed. So, we do look at our methodology, how uh, the performance is coming, and what are the attributes of that performance, on what basis, which factors are performing, which factors are not performing, all of that. But we really can't comment on on a stock really. And secondly, how much of your portfolio rebalancing and stock discovery is driven by AI? I think very little. Although we are spending or investing a lot of time in using AI, but most of the AI driven benefits have been in our business operations, and very little on the portfolio construction side. So we are definitely trying to figure out. We have figured out, as I said, we use almost 130 alphas. We have figured out few alphas, but they haven't driven any or given us any edge from what we already have. So we are definitely working on it. But on the portfolio construction side, it's close to zero. But on the business operations side, be it in our sales process, in our marketing or internal operations, we are using AI quite heavily and deriving a lot of benefits from that. Okay, Firdaus is asking, what's the rationale behind including so many pharma stocks, especially at a time when there's uncertainty around Trump potentially imposing tariffs on pharma sector as well? So Firdaus, again, uh, hard for us. We don't really comment on stock and specific stocks or pharma or sectors because this is actually driven by the methodology we have, and we are quite confident about our methodology. We still keep working on it and improving it, but we are quite confident about our methodology. And these kind of things can happen. It's see, there are few things that are dependent on luck. You really cannot, in no methodology, you can't take into account these kind of things which are not in your control. So we don't really worry too much about these kind of things. There are a lot of things which are not in our control. These kind of things can happen. They have happened in the past, but in spite of all of these things, the methodology should be such that you should be able to adapt at a quick pace, and that's what we do. Adapt rather than predict. Uh, with an XIRR of 10% over 2 years, starting from September 23, how should I plan from next year onwards? So, Srinivas, I think this is whatever comments I'm saying, most of it is actually valid for all equity investments. I'm not necessarily talking here about specifically about Gulaq, but in general about equity investments. That uh, in equity you should only put that money which is available to you for long term. So if it is available You just have it for 1 or 2 years, and after that you might need to take it out. Please do not put that money in equity. It's not right strategy. Ideally, 3 to 5 years. The longer it is, the better it is for you. That is one thing. And secondly, no point about predicting markets. It's very hard thing to do. There's very little edge really. So if you are a long-term investor, what our advice is and what has worked in the past is a systematic investment plan, so that you put in money every month. You are making money from your business or from your salary. You take a part of it and invest it, and do that year after year for a couple of years, and that's when you start seeing good results. Your results would definitely not be visible to you in 1, 2, 3, 4 years, but if you can have a horizon of, say, let's say next 10 years, you'll be really surprised by what your portfolio, the size of your portfolio. In most things in life, be it your health or anything that you're learning or in investing, what happens is we tend to overestimate what we can achieve in short term, and we tend to underestimate what we can achieve in long term, really. That's what happens. So we are always looking at short term, and we are always trying to overestimate what we can achieve. But it's really the long term where we frankly hugely underestimate what we can achieve. So my advice would be it Gulaq portfolios or any other mutual funds, you keep investing over long run, and that's when you will see the benefit of investments. Ruturaj is asking, hi Vivek, good evening. I've been an investor in Gulaq for past 2 years. As you can probably figure out, I've initially invested when the markets were high and then topped up a few times. Since the market is currently volatile and trading about 7 to 8% below its peak, should I continue with SIP or top up more? Yeah, Ruturaj. So, see, what I've just spoken about, don't worry about where the markets are trading, frankly. It's not in your control. What we have seen over long term, over every 10 years, market triples. So they give roughly around 12%. If they give 12%, and that's what almost every 10 years, that's the average returns have been 12% annualized. If you get that, you triple the money. Obviously, you keep on putting in money, so that money is more than tripled. But that is what your expectation should be, right? And don't worry, because every few years you see, in 2020 we had COVID. Prior to that, in 2008 we had the global financial crisis where markets dipped by more than 50-60%. Same in so every couple of years we see big events which tank the market by almost 50%, and every couple of years you see smaller things like Russia-Ukraine war, India-Pakistan issue, or maybe Trump tariffs, which impact the markets by about 10-20%. You really cannot predict these things, but this is nature, that this will keep on happening. But over longer run, there is no reason why uh, over the next 10 years the returns would not be, say, about 12% analyzed, right? So broadly in that range you should expect over longer run. So my advice to you would be, if you can continue doing those SIPs, and you'll be amazed by the kind of portfolio you'll have in next 10 years time. This month after the rebalance, all my stocks are going up. Which ones should I sell now while they're high? If I don't sell, I'm worried I might miss out on the profits and end up with losses. Also, could you please provide an update on the stock average? If I if one stock is down, would still like to receive an overall average update. So I didn't really understand about the stock average. The first part, obviously, what I would answer is, um, see, in this case, you are paying a fees to us to advise you. Our advice is always that please don't look at it from an individual stock perspective. because there'll definitely be few stocks which are doing much better than average, and there'll be few stocks which are doing below average. It's very hard for anyone to predict which ones would be the ones who would end up in losses. So our advice is, please, whatever rebalance update we are pushing, please accept as it is. If you really think you can, uh, or you want to take call on these stocks, maybe open a separate brokerage account, do it on your own for 1 year, and see where you stand versus what we have been able to deliver. And if you feel that you have been doing well and you can definitely do well, then obviously go ahead with what you have been doing. Uh, but most of the investors really have seen that they are unable to even replicate the index. They end up underperforming even the index. That's the case with most of the investors. So, advice from our side is, please don't look at it individually, stock wise. Sometimes you might be right, sometimes you might be wrong, and over long run, this exercise really wastes a lot of time. It gives us some bit of comfort that because we are doing something about it, we are in control, but it's of no use. So that's what our advice would be. Okay. Now let's move on. Priya has asked, hello, I joined Gulaq on 17th November 23, but I'm still at a loss. I plan to hold the fund for the next 1 year. Can I expect to see profits 1 year or even during the year? Yeah, Priya. So, see, investing is a game of probability. Uh, so, the longer you hold, the more probabilities you will have in your side. So if we just talk about index, let's say, uh, I think probability of index giving a profitable day, a positive day is close to 50%. I don't remember the exact number, but 53, 54% tha that. So 47, let's say 3% or 53%. So 47% of the days you will end up in a loss. Okay, now let's move on to if you hold for a month, then that number increases to about 60%. So roughly 60% of the month you will be profitable, 40% will still be loss making. Now, if you increase your holding to 1 year, then it becomes slightly higher than 70%, right? So the probability of you making a profit over next 1 year is about 70%. You move that to 5 year, I think over 5 year it's almost 98, 99%, given that you will make a profit, you'll end up in profit. So the point here is again similar thing, that the longer you hold equities, the higher probability you are going to have. But again, it's a probability, it's a game of probability. It'll never be 100%. So there obviously have been cases in the past, India and US, Japan, everywhere, that even on a 10-year duration, uh, equities have not given a profit. It has been flattish, zero returns over a 10-year period. That has been the case. But even in those cases, if somebody were doing SIP, so a lot of it actually you would have ended up or beaten the inflation over that 10-year period, even though point to point returns were zero, because as the markets were going down, you kept on buying and you kept on buying more units, because if the price is coming down with the same amount of money, you will get more units, right? And the more units you keep getting, when it recovered all the losses, you will actually end up in a decent profit. So that's what the point is. The longer you hold, the longer, the higher the probability will be of you making profits. And again, this is not only about Gulaq Gear 6, but any other mutual funds also that you are holding. I personally, what I do is I invest a lot in other mutual funds also. I tend to give about 3 years. So even over 3 year period, if they haven't beaten the benchmark and have done quite badly, obviously then I review and almost always I'll get out. But 3 year is a period that I personally look at. It's very hard to say whether three is the correct or not, but personally, 1 year for me is a bit too short, really, right? So yeah, that's what my take is. Next, Pratik is asking what should be the ideal amount I should invest in this small case to realize its full potential. So, Pratik, obviously, the higher it is, the better it is for you. Say, if you are investing 6 lakhs and paying 6,000 fees, so you are just paying 1%. Whereas somebody who has invested 60,000 rupees, he would be paying 10% of his AUM as fees. So one point is that. So ideally, I don't think anyone should pay higher than 2% on any kind of portfolio management. So with that 2%, the amount that comes out to be is 3 lakhs. So I think 3 lakhs is definitely you should have. But after 3 lakhs, the higher it is, the better it is for you. So yeah, minimum I would suggest about 3 lakhs or so. Yeah. So that's about it from our side. I think, Ankit, if you have received any questions, let's take those questions.
Yes, Vivek, we have received a bunch of questions. So the first question is from Ms. Kuzi. He is asking, will you be able to provide the rolling return figures as they give a clearer picture? So definitely, Ms. Kuzi, you can in fact download the NAV series by visiting smallcase.stadvisors.com and compute these rolling returns for yourself. But if you don't want to do that or don't know how to do that, you can just message our support team and we are happy to do that for you. We'll provide you the rolling returns.
Ankit, we can do one more thing. We have just launched our WhatsApp channel, right? So maybe we can also quickly compute it and put it out there for everyone to see. So, guys, we just Ankit just mentioned in the initial part about our WhatsApp channel. So please log on to that, follow that, join that specific Good Luck WhatsApp channel. And in the next couple of days' time, we will compute these rolling returns and we can post it out there as well.
Sure, Vivek. Next question is from Pallab Sarkar. He's asking, hi, I have been a Gulaq ESS subscriber for around 1 year and 9 months now. My XIRR on the app is close to 6%, which seems to be very less than the returns that you are presenting. Please help me understand this. So, Palak, see the returns that we present are time-weighted returns, which are basically CAGR returns, and the XIRR that you see on the app terminal on your small case terminal, it is your personal XIRR depending upon the timing of your personal investments. So, as a fund, we always show out the time-weighted return. We cannot show the XIRR. So XIR often depends upon the timing of your investments. So maybe I'm just guessing here, but looking at your figure, I'm guessing that you might have invested when the fund was doing at its peak, which was at its peak, and would have withdrawn the money when it was not doing well. So you suffered a loss at a higher capital and suffered and saw a gain at a lower capital, which sort of drags down the XIRR. So what you can do is you can just share us the screenshot of the returns that you're seeing on your terminal and request an order book of Gulaq KR6 from small case and share both of that with our customer support team. And I'll be happy to break down your portfolio's performance against the model portfolio and see where the discrepancy is lying. And in case there is any sort of course correction that you can do, we will definitely recommend that. Okay, so
Yeah, yeah.
next question is again from Palab Sarkar. He's asking, are all the rebalance purely based upon algorithm or is there any human supervision over and above that?
So, Pallab, human supervision is not in the portfolio construction, but after we have constructed, uh, we definitely do see what stocks are working well, what factors and which sectors are working. So all of that analysis and tracking is something that we do very closely, but we don't have any human intervention while in that portfolio construction methodology. So that is fully automated.
Okay. Kalpit is asking, hey Vivek, I am Gear 6 subscriber. Just curious, how confident are you about hitting 8 to 9% alpha you just mentioned over the next 5 years?
Interesting how confident I am. So I would say it's not 100% because if my confidence level was 100%, I would have put every single money in our fund, which is not the case. But majority of my active funds are invested in Gulaq strategies or ST strategies. So I can say I'm fairly confident. Now, if you ask me to put down a number, maybe I would say 70, 75%, 80% in that range. It's not 100, but it's definitely above 50%. But again, that is my personal view. My teammates, everyone has invested in good luck. Everyone has its own opinion. Some people are way more confident than I am. Some are less. I would say if you putting down a number, maybe about 75% or so, somewhere between 70 to 80% is what I would say. Yeah.
Okay. In the last 5 years, we have done much better than 8 to 9% alpha. So it would be interesting to see what alpha we can generate in the next
So,
five
Ankit,
years.
what is it for you?
Uh, I would say I'm also fairly confident that we can achieve 8 to 9% alpha over the next 5 years, considering history is a very good indicator of future. So over the 5 years is a very long period of time to have a live track record. And over those last 5 years, we have shown a very good track record, and PMS is even longer. And overall, if you consider ST as an organization with different strategies, it's even longer, like 10, 15 years also. So I'm fairly confident that Gullag Gear 6 strategy can produce 8 to 9% alpha over the next 5 years as well.
Yeah. But see, these are our personal opinions. You talk
Yeah.
to everyone, they would have their own view. Yeah. So, okay. What's next?
Okay, so Kalpit is asking another question. Just checking if there is any progress with small case allowing additional investment at the time of rebalancing.
No, Kalpit name, right? Kalpit, no, frankly, we haven't heard anything from small case side. So I'm assuming no progress till date on this specific issue. But yeah, we can definitely, we do keep talking to them about this and other issues that investors face. Till now, we haven't had any progress, but we'll again touch base with them to see if they have made any progress on this. But we haven't heard anything from them yet.
We have another question from Palab. He's asking, can you provide any contact number / email ID for him to reach out? Pallav, it's free. It's available everywhere. You can visit our website, gullag.com, or you can just visit the channel in the bio. Also, we have the uh, contact details of our support team. So it's available everywhere. I can also just look it up and paste it in the chat real quick.
Yeah, that's well.
Okay, I think those were all the questions that we had. We'll just wait a couple more minutes in case somebody wants to ask another question.
Sure.
Kalpit is thanking you and me. You're welcome, Kalpit.
Thank you, Kalpit.
Okay, it looks like we are out of question. So thank you everyone for joining this stream. This would be available on our YouTube channel. So in case you miss some segments of it, you can always rewind and rewatch it. Once again, I thank you everybody for joining and spending time with us. This stream would be ending now.
Thank you, everyone.
Thank,
Thank you, Ankit.
thank you, Vivek.